Meet Sarah and John. They are a young couple living in Austin, Texas. For 3 long years, they did absolutely everything right. They skipped the summer vacations. They stopped going out to eat. They drove their old cars into the ground. Every single extra dollar went straight into a savings account for a down payment on their first home. In early March of this year, they finally found it. The perfect house. 3 bedrooms, a nice backyard right in their target neighborhood. And the timing felt like destiny. The 30-year fixed mortgage rate had just dipped below 6%. They ran the numbers. The math worked. The monthly payment was right in their comfort zone. But they hesitated. Just for 14 days. They thought the market was cooling down, so they tried to negotiate a slightly better deal on the purchase price. They thought they had time. They didn't. That 2-week hesitation didn't just cost them a deal. It cost them their American dream in just 14 days. Mortgage rates violently spiked back up, blowing past 6.5% and landing at 6.75%. I need you to understand that this isn't just a tiny fraction changing on a computer screen. In the real world, that sudden jump translates to an extra $300 to $400 every single month. That is tens of thousands of dollars in extra interest over the life of the loan. In just 2 weeks, Sarah and John were officially priced out of the exact same house they could comfortably afford just 14 days prior. This isn't just their story. It is happening everywhere. The housing market is currently facing a massive, entirely new shock. Over a year of waiting, hoping, and praying for lower interest rates has been completely wiped out in just 2.5 months. Today, we are going to strip away the noise. We are going to expose the invisible forces that are actively dragging your mortgage rates higher right now. We will uncover why the mainstream headlines are lying to you about falling home prices. And most importantly, I am going to give you a strategic, step-by-step playbook so you know exactly what you should do with your money in this market. Let's look at the cold, hard data. The speed of this shock is what is so terrifying. Back in March, the 30-year fixed mortgage teased the entire country. It slipped under 6%, and the psychological relief was palpable. Buyers flooded the market. Sellers finally started dusting off those for sale signs. But here we are in May of 2026. We are staring down the barrel of a 6.75% mortgage rate. Now listen to me closely. 6.75% historically speaking is not the end of the world. We survived 8% back in 2023. The actual number is not the enemy here. The enemy is the speed. The sheer violent speed of the jump is what breaks the market. When rates spike this incredibly fast, it causes total psychological paralysis for everyone involved. Buyers freeze because their budgets just exploded overnight. Sellers freeze because they look at their current 3% mortgage, look at a new 7% mortgage and say, "No thanks, I'm staying put." This speed creates gridlock. And here is where the media gets it totally wrong. You have probably seen the clickbait articles screaming about how high rates are causing a housing crash. Do not believe it. Look at the actual data from April. Despite rates surging upward, national home prices actually ticked up 0.2% from the previous month. They are up 2.1% compared to a year ago. Why on earth are prices going up when money is so expensive? Because we have a massive, crippling shortage of affordable homes. The starter homes simply do not exist in the numbers we need. So when a reasonably priced house does hit the market, people are still fighting over scraps. Demand is lower, yes. But supply is so incredibly low that it acts like a concrete floor, keeping prices glued to the ceiling. So who exactly is pulling the strings here? Why did your mortgage get hundreds of dollars more expensive out of nowhere? Spoiler alert, it is not your local bank manager being greedy. Your mortgage rate is tied to an invisible thread. It is chained directly to the United States 10-year Treasury yield. Think of the 10-year Treasury as the heartbeat of global borrowing. When it gets more expensive for the U.S. government to borrow money, it automatically gets more expensive for you to borrow money to buy a house. But why is the government's borrowing cost spiking right now? To answer that, we have to look across the ocean. We have to look at geopolitics, specifically the massive tensions in the Middle East right now. Tensions involving Iran and the Strait of Hormuz. That tiny, incredibly vital strip of water handles roughly 20% of the world's global oil supply. When the threat of conflict rises in that specific region, the oil markets get extremely nervous. And when oil gets nervous, prices skyrocket. This triggers a massive, unstoppable domino effect that ends right at your wallet. Let's talk about the petrodollar. When global oil supply is threatened, energy prices surge. The countries exporting oil, particularly in the Gulf, either pump less oil or they hoard their cash for geopolitical security. That means they have fewer US dollars flowing through their hands to buy American debt. Some nations might even start dumping the US bonds they already hold. When the global demand for US bonds drops, the US government has a major problem. They still need to fund the country, so they have to sweeten the deal. They are forced to raise the interest rate on those bonds just to attract buyers. And right behind that geopolitical mess is the ultimate boogeyman: inflation. Bond investors are calculating ruthless people. If they see oil prices spiking, they know gas prices are next. If gas prices spike, the cost of shipping every single item to your local grocery store goes up. Inflation comes roaring back to life. If an investor expects inflation to hit 5%, they are absolutely not going to accept a government bond that only pays 4%. That guarantees they lose purchasing power, so they demand higher yields to protect their money. The bond yields spike, the mortgage rates follow them up like a shadow, and you, the average American homebuyer, end up footing the bill for global chaos. But hold on a second. I need to tell you a secret about the national average home price. It is a complete lie. There is no such thing as a single U.S. housing market. There are thousands of hyper-local distinct markets. Do not let that national 2.1% increase fool you. Right now, a brutal reality check is tearing through some of the hottest real estate markets in the entire country. Let's look at the Sun Belt. Florida, Texas, California, cities like Cape Coral and Austin. Just a few years ago, these were the absolute darlings of the pandemic era. Millions of people flocked there for the sunshine, the space, and the promise of cheap living. Well, the cheap living is officially dead. First quarter data for 2026 shows a startling reversal. Home prices are actually falling in 39 out of 129 major metropolitan areas. The Sun Belt is bleeding value. Why? Because of a hidden enemy that no one talks about until it's too late. It is not just the mortgage rate that is killing these markets, it is the true cost of keeping the house. Property taxes in these booming states have caught up with the inflated home values, but the real ultimate killer is natural disaster insurance. Insurance premiums in states like Florida and California have gone absolutely nuclear. You might be able to stretch your budget to afford the mortgage payment, but when the insurance company demands thousands of dollars more a year just to cover hurricane or wildfire risk, it bleeds you dry. It is completely crushing the purchasing power of the middle class. Homeowners in these areas are getting squeezed so tight by taxes and insurance that they are being forced to sell. They are putting their homes on the market. Inventory in these specific areas is piling up fast, and sellers are being forced to slash prices to get out. If you live in the Sun Belt, the rules of the real estate game have completely changed. So where does that leave you? Do you just give up on the idea of homeownership? Do you just accept defeat? Absolutely not. You just need a new playbook. You need to adapt to the 2026 reality. Let's talk real strategy. If you are a buyer in this market, you actually have massive leverage. You just have to know exactly where to look and how to use it. Forget about fighting over existing homes with stubborn sellers. Look at the home builders. The companies building brand new construction have a massive problem on their hands. Over the last 2 years, they built a ton of houses to meet pandemic demand, and now they have heavy inventory sitting empty, costing them money every single day. They are incredibly desperate to close deals and get those liabilities off their books. But here is the secret. Do not ask them to lower the price of the house. Ask them to buy down your rate. It is called a builder buy down. The builder will literally take their own profits, thousands of dollars in cash, and pay the bank upfront to permanently or temporarily lower your mortgage rate. While everyone else in the market is stuck crying about a 6.75% rate, you could be locking in a rate in the low fives purely using the builder's money. That is how you use leverage to win. And what if you are looking at existing homes? Well, the lock-in effect is starting to crack. Inventory of existing homes is actually up about 20% compared to last year. Sellers are getting tired of waiting for rates to drop. They want to move on with their lives. Because of that extra inventory, you have the power again. The days of waiving your inspection and bidding $50,000 over asking price are over. You can demand a proper home inspection. You can ask the seller to pay your closing costs. You do not have to bid blindly anymore, but what if you run the numbers, you negotiate hard, and the math still just doesn't work? What if buying a house right now will completely choke your monthly budget and leave you broke? I need you to hear this loud and clear, and I need you to unlearn everything your parents and society told you about real estate. Renting is not throwing money away. Let me repeat that because it is the most important thing you will hear today. Renting is not throwing money away. In this specific market, renting is a highly tactical, incredibly smart financial decision. Over the last few years, commercial builders flooded the market with multifamily apartments. Supply is massive. Vacancies are ticking up. Because of that oversupply, rent prices have essentially flatlined, and in many major cities, they are actually dropping. Now compare the cost of renting a nice apartment to the cost of taking on a massive mortgage at nearly 7%, plus property taxes, plus maintenance, plus insane insurance premiums. In many markets today, renting is hundreds, sometimes over $1,000 cheaper per month than buying the exact same square footage. Choosing to rent right now is a defensive strategy. It allows you to build a massive fortress of cash. It protects you from becoming house poor and trapped in an asset that drains your bank account. Keep your cash highly liquid. Put it in a high-yield savings account, earning solid interest. Preserve your capital. And wait patiently for your perfect strike on the housing market. So what happens next? Where do mortgage rates go from here? The brutal honest truth is that nobody knows. Anyone who tells you they know exactly what rates will do next week is lying to you. It all comes down to energy inflation and the decisions of the Federal Reserve. And right now, the Fed is trapped in a nightmare scenario. If they print money and cut rates to save the housing market, inflation could go nuclear all over again. But if they do nothing and keep rates high, the middle class continues to get crushed. My advice to you is simple. Do not try to time this market. Do not play roulette with your life savings trying to guess what Jerome Powell and the Fed will do next month. You buy a house when your personal finances are absolutely bulletproof. You buy when the monthly payment fits comfortably inside your budget, leaving you room to save and invest. You buy when it makes sense for you, regardless of the macroeconomic chaos happening outside your window. Your financial peace of mind is worth infinitely more than any piece of real estate. So I want to turn it over to you. Look out your window. What is happening in your specific neighborhood right now? Are prices actually dropping? Or are people still overbidding for shacks? And where do you honestly think mortgage rates will be by the time Christmas rolls around? Drop your thoughts in the comments below. I read every single one. If this video helped you see the matrix of the housing market, hit that like button. Make sure you subscribe to FinDocs, and I'll see you in the next one. Stay smart with your money.